Hello, welcome, Guy Wagner, CIO of BLI Banque de Luxembourg Investments, and thank you very much for joining us for this interview this morning. The beginning of the year has been very turbulent in the economic and financial world. One crisis follows another. Despite these circumstances, the global economy is holding up pretty well. How do you explain this resilience?
I would say that when you look at the economy, the manufacturing sector currently slowing down, but the service sector is still doing well. And service sector basically is doing well because in most regions unemployment is quite low. Wages have been growing. Obviously, there was a problem with inflation, but generally speaking, wages have been growing. And finally, also after the reopening of the economies, one has the impression that people still want to travel, they still want to go to restaurants. So all these activities are still supporting the economy.
There are, however, few indicators that are starting to flash red, such as the weakness of the real estate sector and the turnaround in corporate profits. Does this mean that we have reached the top of the curve and that we should expect to fall again in the coming quarters?
Yeah, I would say that logic would have it that the economy should slow down in the second part of this year. Obviously, last year we had the tightening of monetary policy of the central banks, which started basically in March. There's always some kind of a delay between the rise in interest rates and the impact on the economy. Normally, one assumes that the delay is somewhere between 12 and 18 months. So given that interest rates started to rise, let's say in the second quarter of last year, one would expect for the economy to feel the impact, let's say in the second half of this year or maybe in the fourth quarter of this year. And when you look at history, that would normally mean that there is clearly a risk of recession in the US, but also obviously then in Europe.
In particular, the forecasts are not very optimistic in the United States, following the implementation of a very aggressive monetary tightening policy by the Federal Reserve. And we also had the resounding bankruptcy of the Silicon Valley Bank, which shook the markets. Would a recession in the United States have negative consequences for the rest of the world?
Yeah, I would say that would normally be the case. One can say that the US economy is still the main engine of the world economy. So from that point of view, if the US economy were to enter a recession, then the impact would be felt on other regions and especially in Europe.
Europe has not been spared by the banking turmoil, with the crisis of Credit Suisse saved in extremes by a merger with its Swiss competitor UBS. Even if the reasons are obviously different from 2008, one has the impression that the lessons of these last major financial crises have not really been learned. What is your view on that?
I think generally speaking, one has to say that banks are better capitalized now than they were what was 15 years ago, especially in the US. So from that point of view, I think the situation is different. On the other hand, clearly with the monetary policies that we had over the last 10 or 15 years, with very low interest rates or even negative interest rates, there are a lot of risks that have been taken by a lot of actors. And clearly that for certain banks, that might mean that potentially there are problems in their balance sheets.
Inflation is still on everyone's mind, with figures that are sometimes staggering on consumers calculating when they get to the supermarket cash desk. What is your outlook on this topic?
Inflation, or as you say, inflation has come down quite a bit since, let's say, the middle of last year, especially in the US. On the other hand, when you look behind the official inflation numbers, you see that core inflation, so excluding maybe oil and even food prices, core inflation remains quite sticky. So from that point of view, it hasn't really come down this year. And I suppose that's also a main area of concern for the central banks. This being said, I think that normally if you assume that the economy will slow down, normally with certain delay, you should see inflation coming down going forward. But I think one also has to be aware that a lot of the disinflationary forces that we've seen over the last 15 years are gradually disappearing.
In your latest edition of Perspectives, you talk about a structural transition in the global economy, which is painful, as transitions often are. What exactly are we talking about?
Yeah, this was a little bit this idea I just said about, for example, inflation. We had over the last maybe 30 or 40 years, we had basically a period where inflation came down, interest rates came down, and then inflation stabilized at a very low level, around 1 or 2% in the most industrialized nations. And I think that might change going forward. When you look at a lot of the trends, whether it's demographics, whether it's linked to fiscal policy, whether it's linked to maybe the supply of commodities or even of labor, a lot of these trends that used to be, or when you look at globalization, a lot of these trends that used to be disinflationary seem to change now. Obviously, still have technology as a very big disinflationary force, but the other forces seem to be going in the other direction now. And that's a little bit the similarity with the 70s when we also had a few periods where inflation went up quite a bit.
In this context, after a difficult year in 2022, the financial markets have started to rise again. This rebound was more or less expected. Is it as significant as expected?
I think the rebound was quite nice in most of the regions. The stock market went up by something around 7, 8, 9% for in 3 months, in a 3 months time. So from that point of view, I suppose the rebound is quite a normal rebound. This being said, I think it's, I don't know whether it was necessarily expected. When you look at last year, stock prices went down because valuations fell. Company earnings continued to increase. This year, with now the renewed decline in bond yields, valuations started to rise again. So I suppose these are the main factors which are behind the rebound that we saw in the first quarter.
What can a private banker say to reassure an investor who is a little frightened by the current economic and political turmoil and who is in doubt?
I would say that when you look at different kind of assets that you can buy as an investor, when you look at the traditional investments, you have equities, bonds, and cash, if you want. And first of all, you could say that at least remuneration that you get on fixed income has improved a little bit. So from that point of view, if you really are too afraid to invest in equities, and at least contrary to what we had seen for a very long time, at least you get some interest rate again on fixed income. And when it comes to equities, I think the thing to remember is always that over the medium to long term, the equity prices of quality companies are doing well. They might suffer temporarily, but long term, they're doing well because they are strong companies. Because they even during difficult times, they might be able to improve their market share, or they might buy their competitors. So from that point of view, we're still big believers in the shares of quality companies.
The decline in bond yields has been favorable to so-called growth stocks, particularly technology stocks. Do you recommend investing at this moment?
When it comes to technology, you have to be aware that technology sector has obviously been the big beneficiary of the last of the period of declining interest rates. So it has massively outperformed over the last 15 years, basically since the financial crisis. And history tells you that the winners of the past are not necessarily the winners of the future. And so from that point of view, obviously a lot of these technology companies remain very good companies. But when you look at their stock price, you see that contrary to what was the case maybe after the financial crisis, their earnings nowadays are much higher, their valuations are much higher. So from that point of view, for me, I have trouble seeing them outperforming the market massively over the years to come.
Do you fear a danger of overheating prior to possible future collapse?
No, I don't see a lot of signs of overheating right now. Investors don't seem particularly euphoric. Quite the contrary, a lot of people seem to be very worried. They realize that there are risks when it comes to the economic situation, when it comes to the geopolitical situation. So from that point of view, I don't see necessarily right now a lot of euphoria in the market.
So what other types of investments do you think are the most promising in the current environment?
Yeah, basically, I'm coming back to what I just said. The investments or the asset classes that traditional asset classes are fixed income, so cash and bonds and equities. And as I said before, I still think that equities make a lot of sense for someone who has a longer investment horizon. But for someone who is afraid of equities right now, at least fixed income offers you some kind of decent return again, contrary to what was the case basically for maybe 10 years.
Let's finish as always with a word about gold. It was a little heckled last year, but is now at its highest level since 3 years. Do you think this uptrend will be sustainable?
Yes, I think that the structural trend when it comes to gold is upwards for the very simple reason that when you look at the supply of what's always called fiat currencies, so paper money compared to supply of hard currency like gold, I think the supply of fiat currencies is only increasing and will continue to increase, whereas the supply of gold by definition is quite limited.
Guy Wagner, CIO of BLI, Banque de Luxembourg Investments. Thank you very much.
Thank you.